What is happening, everyone, and welcome back to Bitcoin Bulletin. The digital asset space is absolutely on fire right now, with developments happening at lightning speed, and if you're not plugged in, you're missing out. We've got a packed show today, featuring some of the most significant shifts in the market that could redefine how we interact with digital finance. Get ready, because you're about to get the unmissable updates you need to stay ahead of the curve. First up, we're diving deep into the complex world of corporate treasuries and the intricate risks they're navigating in this volatile market. Then, we're heading across the pond to see how one nation is making a monumental bet on Bitcoin, potentially leaving others in the dust. After that, we'll unpack why major institutions are starting to take Bitcoin much more seriously, signaling a major turning point. And finally, we've got a revolutionary development that could transform Bitcoin into a true payment powerhouse. You do not want to miss this. Stick around, because it's all happening right now on Bitcoin Bulletin. Corporate Bitcoin holdings face scrutiny. Corporate treasury departments worldwide are increasingly exploring the integration of Bitcoin into their financial strategies, a move that promises significant potential, but is also fraught with complex challenges. As more companies consider adding Bitcoin to their balance sheets, they must meticulously navigate a landscape of legal, financial, and accounting risks that are unique to this nascent asset class. The inherent volatility of the cryptocurrency market, while offering opportunities for substantial gains, also presents considerable downside risks that require robust risk management frameworks. Companies must grapple with regulatory uncertainty, as the legal status and treatment of Bitcoin can vary significantly across jurisdictions and are subject to change. This includes understanding compliance requirements related to anti-money laundering, AML, and Know Your Customer, KYC regulations, which are still evolving for digital assets. From a financial perspective, the accounting treatment of Bitcoin presents a unique hurdle. Unlike traditional assets, accounting standards for digital currencies are not as well established, leading to diverse interpretations and potential complexities in financial reporting. This can impact a company's reported earnings, asset valuation, and overall financial health. For instance, the classification of Bitcoin as an intangible asset versus a commodity or currency can lead to different accounting treatments for gains and losses, impacting tax liabilities and financial statements. Furthermore, the custodianship of Bitcoin requires secure digital wallets and robust cybersecurity measures to prevent theft or loss, adding another layer of financial and operational risk. Companies must decide whether to self-custody their Bitcoin or utilize third-party custodians, each with its own set of risks and benefits. The financial implications extend to treasury management, where companies need to develop strategies for acquiring, holding, and potentially transacting with Bitcoin. This involves managing foreign exchange risks if purchasing Bitcoin in different currencies, as well as liquidity management to ensure sufficient funds are available for operational needs while holding a potentially illiquid asset. The tax implications of Bitcoin holdings, including capital gains taxes on disposal and potential income taxes on mining or staking rewards, also need careful consideration and planning. The market's volatility means that the value of Bitcoin holdings can fluctuate dramatically, impacting a company's net worth and financial ratios. This necessitates sophisticated treasury operations that can monitor market conditions, manage exposure, and adapt to rapid price changes. The integration of Bitcoin into corporate treasuries is not merely a financial decision, but a strategic one that requires a holistic approach, encompassing legal compliance, financial reporting accuracy, operational security, and dynamic risk management to ensure sustainable adoption and mitigate potential pitfalls in this evolving financial frontier. This intricate balancing act is sparking widespread discussion among financial professionals and corporate leaders, with many keen to understand how to harness Bitcoin's potential while safeguarding against its inherent risks. Now, hold on to your hats, because the next story reveals a nation making a bold, strategic move that could reshape the global financial landscape. We're diving into how the United States is going all in on Bitcoin and what that means for the rest of the world. United States bets big on Bitcoin, leaving Europe behind. the United States is making a significant and increasingly visible commitment to Bitcoin, a move that appears to be positioning the nation at the forefront of digital currency adoption, while many European nations lag behind. This strategic embrace is evident through substantial investments and the development of key infrastructure within the country. A prime example is the reported acquisition of $2 billion worth of Bitcoin by the American president's company, Trump Media and Technology Group, in July. Beyond this, presidential family members have been actively involved in the burgeoning Bitcoin mining sector. The launch of the American Bitcoin miner last March, a subsidiary 80% owned by Hut 8, another prominent American miner, underscores this commitment. This venture is poised for a stock market listing in September and boasts significant operational capacity. Hut 8 currently operates with a computing power of 8.85 AS. With American Bitcoin aiming to reach 10 AS, the company has made substantial capital expenditures, recently finalizing the purchase of 16,299 Antminers S21 from Bitmain for $314 million. Furthermore, its financing plan includes acquiring an additional 15 AS, which would elevate its total computing power to 25 AS. This expansion would position the group among the top American miners, rivaling established players like Marathon, approximately 50 AS, CleanSpark, around 40 AS, and Riot, approximately 31 AS. Considering the global hash rate has just surpassed 1 ZHS, equivalent to 1,000 AS, these moves represent a substantial contribution to the US's mining dominance. Adding to this momentum, Block has developed machines that rival those of Chinese manufacturer Bitmain, further enhancing the nation's sovereignty in Bitcoin mining operations. The data indicates that the United States currently controls about 35% of the global hash rate, significantly more than Russia's approximately 17% and China's 15%. This growing self-sufficiency in mining infrastructure is a critical component of the nation's embrace of Bitcoin. The presidential interest in Bitcoin appears to be a genuine driver, with signals suggesting that the United States may be preparing to establish Bitcoin as a key reserve currency. This aligns with the objectives of figures like Senator Cynthia Lummis, whose Bitcoin Act bill proposes the accumulation of 1 million Bitcoins through the strategic sale of a portion of the nation's gold reserves. Meanwhile, Europe appears to be notably absent from these developments. Despite hosting leading Bitcoin wallet providers like Ledger and Trezor, the continent lacks large-scale mining operations. This absence is particularly striking given the potential benefits Bitcoin mining offers to the European energy sector. Specifically, Bitcoin miners can help balance electricity grids by consuming surplus energy, especially from intermittent renewable sources like wind and solar. This capability is crucial for stabilizing grids and reducing the strain on traditional power infrastructure, such as nuclear plants that face operational challenges when forced to constantly modulate output to compensate for renewable energy fluctuations. Such modulation can lead to wear and tear on these plants, representing a significant waste of energy resources. Bitcoin miners can act as a flexible load-shedding solution for grid operators, reducing the need for expensive peak power plants. This symbiotic relationship is already proving effective in regions like Texas, where the local grid operator, ERCOT, has canceled the construction of several gas power plants due to the capacity of Bitcoin miners to return over 3 GW to the grid instantly and without time limits. The broader economic context also plays a role. With the U.S. national debt reaching $37 trillion and the dollar's purchasing power declining, there is a global search for stable reserve assets. As BRICS nations, led by Russia and China, reduce their reliance on financing American debt, and the dollar's share in foreign exchange reserves declines, the U.S. faces a strategic imperative. The potential for Bitcoin to serve as a stateless, uncensorable currency with a fixed supply of 21 million units makes it an attractive alternative, especially as a hedge against inflation and dollar devaluation. As former White House advisor Bo Hins suggests, the U.S. government may act swiftly to accumulate Bitcoin for its strategic reserves before the year ends. This global shift in financial strategy is undeniable, But what about the institutional side of things? We're about to explore why major financial players are starting to take Bitcoin incredibly seriously, and what that means for its future value. Institutions embrace Bitcoin as volatility declines. Bitcoin is undergoing a quiet yet profound transformation, marked by a significant reduction in its volatility and a growing acceptance among institutional investors. This shift is highlighted by a recent analysis from J.P. Morgan, which predicts a potential surge in Bitcoin's price to $126,000 by the end of 2025. This optimistic outlook is underpinned by a remarkable drop in Bitcoin's 6-month rolling volatility, which has fallen from nearly 60% at the beginning of the year to around 30%. This level of stability, comparable to that of gold, is making Bitcoin increasingly attractive to risk-averse institutional investors who prioritize capital preservation and predictable returns. The declining volatility ratio between Bitcoin and gold, now at its lowest recorded point of 2, signifies that Bitcoin requires only twice the risk capital of gold for portfolio allocation. This convergence in risk profiles is a crucial factor driving institutional interest. A key driver of this enhanced stability is the increasing accumulation of Bitcoin by corporate treasuries. J.P. Morgan noted that corporations now hold over 6% of Bitcoin's total supply, a trend that functions similarly to quantitative easing in traditional finance by absorbing market volatility. Companies like MicroStrategy and Metaplanet are at the forefront of this movement. Metaplanet's recent inclusion in the FTSE All-World Index, for instance, is expected to generate substantial passive inflows from index-tracking funds, further stabilizing Bitcoin's market presence. J.P. Morgan's analysis suggests that Bitcoin's market capitalization needs to grow by approximately 13% to match the private gold investment market on a risk-adjusted basis, which would translate to a price of around $126,000. This valuation assumes continued stability in Bitcoin's volatility and sustained institutional adoption. The gap between Bitcoin's current price and this theoretical valuation has narrowed considerably, indicating significant potential for future appreciation. The structural inclusion of Bitcoin-related equities in major global equity benchmarks is also playing a pivotal role in this institutional legitimization. As more companies with Bitcoin exposure are added to these indices, passive capital flows into Bitcoin are expected to increase, aligning the digital asset more closely with traditional investment vehicles. While J.P. Morgan acknowledges that volatility risks may persist, the firm emphasizes that these structural factors, such as index inclusion and corporate treasury holdings, are fundamentally enhancing Bitcoin's legitimacy and appeal among institutions. This growing institutional embrace suggests a maturing market where Bitcoin is increasingly viewed not just as a speculative asset, but as a credible store of value and a potential hedge against inflation. The transition from early adopters to mainstream institutional participation marks a significant milestone in Bitcoin's journey towards broader financial integration. This institutional shift is monumental, but what about the practical, everyday use of Bitcoin? Get ready, because our final story reveals a development that could turn Bitcoin into a global payment powerhouse. Tether's USDT on Bitcoin via RGB, a payment revolution. A groundbreaking development is set to dramatically enhance Bitcoin's programmability and payment ecosystem, with Tether's USDT leveraging the RGB, really good, smart contract layer. This integration promises to unlock new functionalities for Bitcoin, transforming it into a more versatile platform for transactions and financial applications. RGB, a client-side validated smart contract system, operates on Bitcoin's blockchain by using Bitcoin's UTXO model, ensuring that all transaction data and commitments are anchored to the Bitcoin main chain. This approach maintains Bitcoin's core security and decentralization while enabling complex smart contract functionalities, such as the issuance and transfer of stablecoins like USDT directly on the Bitcoin network. The integration of USDT, the largest stablecoin by market capitalization, onto the Bitcoin network via RGB is a significant event. It allows users to hold and transact USDT in a manner that is anchored to Bitcoin's security. This means that while the USDT transactions themselves are managed off-chain or through client-side validation, their integrity and existence are ultimately secured by the Bitcoin blockchain. This offers a compelling proposition, leveraging the robust security of Bitcoin for the stability and utility of a major stablecoin. This move could significantly boost Bitcoin's utility beyond being just a store of value, positioning it as a foundational layer for a broad range of financial services and payment solutions. For users, this integration could mean faster, cheaper, and more efficient transactions for USDT. By utilizing RGB's capabilities, Tether can issue and manage USDT in a way that minimizes on-chain bloat and maximizes privacy, as transaction details are validated by the involved parties rather than being broadcast to the entire network. This client-side validation model is a key innovation, allowing for complex smart contracts and asset issuance without compromising the scalability or security of the Bitcoin base layer. It effectively separates the complexity of smart contract execution from the core Bitcoin ledger, which remains focused on its primary role of securing transactions and providing a decentralized settlement layer. The implications for Bitcoin's payment ecosystem are profound. It opens the door for a wide array of tokenized assets, decentralized finance, DeFi applications, and payment solutions to be built directly on or anchored to Bitcoin. This could include everything from tokenized real estate and securities to loyalty programs and micropayments, all secured by Bitcoin's network. The ability to issue and manage assets like USDT with the security guarantees of Bitcoin addresses a long-standing desire within the crypto community to expand Bitcoin's functionality without compromising its core principles. Furthermore, this development could attract more users and developers to the Bitcoin ecosystem, fostering innovation and driving wider adoption of Bitcoin as a comprehensive financial infrastructure. The partnership between Tether and the RGB project represents a significant step towards realizing Bitcoin's potential as a programmable money system. It demonstrates a viable pathway for scaling smart contract capabilities on Bitcoin, addressing criticisms about its perceived limitations in this area. As the technology matures and adoption grows, we could see Bitcoin evolve into a dynamic platform supporting a diverse range of digital assets and financial applications, all while retaining its robust security and decentralized nature. That's a wrap on today's top stories, but we've got a quick recap coming your way. Get ready for a lightning round summary of everything we've covered, followed by your chance to get involved. And that's a wrap on another action-packed Bitcoin Bulletin. We covered corporate treasuries navigating risk, the US making a major play for Bitcoin dominance, institutions warming up to the digital asset, and Tether bringing USDT to Bitcoin via RGB. If you found this information valuable, do us a huge favor. Smash that like button, subscribe if you haven't already, and hit that notification bell so you never miss an update. We also want to hear from you, so drop a comment below with your thoughts on these stories. And for even more insights and real-time updates, make sure to follow us on all our social media channels. Thanks for watching, and we'll see you in the next one.